Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of tax hacks every investor should know to maximize profits. Smart tax strategies every investor should know in 2025. Taxes can take a big bite out of your investment returns, but they don't have to. With the right strategies, you can keep more of your hard-earned money working for you. Whether you're a seasoned investor or just starting out, smart tax planning can help you minimize liabilities, boost growth, and stay ahead of the game. This video breaks down practical, effective tax-saving tips that you can use to make the most of your investments. Understanding the basics of investment taxes. If you're investing to build wealth, understanding how taxes impact your returns is essential. Taxes can eat into your profits if you're unfamiliar with the rules, but knowing the basics can help you make smarter decisions. Let's break down some key types of investment taxes to ensure you're not leaving money on the table. Capital gains tax. Capital gains tax applies when you sell an investment for more than you paid for it. But how much you owe depends on how long you held the asset. Short-term capital gains. These are profits from investments held for 1 year or less. They're taxed at your ordinary income tax rate, which could be as high as 37% depending on your tax bracket. Long-term capital gains. If you hold an asset for more than a year before selling, you'll benefit from lower tax rates. These typically range from 0% to 20%, depending on your income level. Why does this matter? Timing is everything. Simply holding onto your investments a little longer can significantly lower your tax bill. Dividend taxes. Dividends are a great way to earn passive income, but not all dividends are taxed the same way. There are 2 types you need to know. Qualified dividends. These are dividends from U.S. corporations or qualifying foreign companies that meet specific requirements. The benefit? They're taxed at the lower long-term capital gains rates. Non-qualified dividends, also known as ordinary dividends, these are taxed at your standard income tax rate. To reduce taxes on dividends, focus on investments that pay qualified dividends, especially if you're in a higher tax bracket. Interest income tax. Interest income, whether it's from bonds, savings accounts, or certificates of deposit, CDs, is generally taxed at your ordinary income rate. Here's how it works. Taxable interest. Most interest falls into this category and gets added to your regular income. This is common with corporate bonds or regular savings accounts. Tax-exempt interest. Some bonds, like municipal bonds, offer tax-free interest. While these may have lower yields, the tax savings can make them a smart choice for many investors. For anyone holding taxable bonds or earning substantial interest, consider the impact on your overall income, especially if it pushes you into a higher bracket. Tax implications of losses. Nobody likes to lose money, but even bad investments can have a silver lining when it comes to taxes. Capital losses can offset your gains, reducing your taxable income. Here's how it works. Offset gains. If you have both gains and losses in the same year, your losses can cancel out your gains, dollar for dollar. Annual deduction. If your losses exceed your gains, you can deduct up to $3,000, $1,500 if married filing separately, from your regular income each year. Carryover rule. Have more losses than the annual limit? Don't worry. You can carry them over to future tax years. This strategy, often called tax loss harvesting, can help you turn a losing investment into a long-term win by reducing your tax burden over time. Understanding these tax basics can help you maximize your post-tax returns and make more informed investment choices. The less you hand over to the IRS, the more you keep building your financial future. Ready for the next step? Let's keep going. Leveraging tax-advantaged accounts for investing. Tax-advantaged accounts are powerful tools for saving and investing. They not only help your money grow faster by deferring or eliminating taxes but also come with added benefits like employer contributions in some cases. Whether your goal is retirement, healthcare, or education savings, there's likely an account that can save you money on taxes. Let's explore the most common options and how they can benefit you. Individual retirement accounts, IRAs. IRAs are a go-to choice for retirement savings, offering two primary options, traditional IRAs and Roth IRAs. Both come with unique tax benefits, and choosing the right one depends on your financial situation and goals. Traditional IRA. Contributions to a traditional IRA may be tax-deductible, which lowers your taxable income now. However, withdrawals during retirement are taxed as ordinary income. If you expect to be in a lower tax bracket later in life, this can be a solid strategy to minimize taxes over time. Roth IRA. While Roth IRA contributions are made with after-tax dollars, no upfront tax deduction, qualified withdrawals in retirement are completely tax-free. This is ideal if you expect your tax rate to be higher when you retire or want to avoid paying taxes on growing investment earnings in the future. The key? Consider your current tax situation versus what you expect in retirement. If you're eligible, contributing to both types of IRAs can diversify your tax strategy for the long haul. 401k plans. If your employer offers a 401k, it's one of the best tax-advantaged accounts you can use. These plans allow you to invest pre-tax dollars, reducing your taxable income in the year you contribute. Over time, your investments grow tax-deferred, meaning you won't pay taxes until you start withdrawing funds in retirement. Here's why 401k plans are especially valuable. Employer matching. Many employers match a percentage of your contributions, often up to a certain limit. This is essentially free money, so always contribute enough to qualify for the full match if you can. Higher contribution limits. Compared to IRAs, 401ks allow you to contribute significantly more. For 2025, the contribution limit is $23,000, with an additional $7,500 catch-up contribution for those 50 and older. For added flexibility, some employers also offer a Roth 401k option. Like a Roth IRA, contributions are made with after-tax dollars, but qualified withdrawals are tax-free. This can be a great choice for high earners or younger workers who anticipate higher taxes in the future. Health savings accounts, HSAs. HSAs are not just for covering medical expenses, they're also an underrated investment vehicle with triple tax benefits. Here's how they work. Contributions are tax-deductible or made pre-tax through payroll deductions, reducing your taxable income immediately. Investments grow tax-free, so any earnings, dividends, or capital gains stay untouched by the IRS. Withdrawals for qualified medical expenses are completely tax-free. It gets even better. If you don't need the funds for healthcare, you can treat your HSA like a retirement account. After age 65, you can withdraw money for any purpose. Non-medical withdrawals are taxed like traditional IRA distributions, but medical withdrawals remain tax-free. Tip: if you're healthy and can cover medical costs out of pocket now, let your HSA balance grow. Many HSAs allow you to invest in mutual funds, ETFs, or other options, turning your account into a long-term wealth-building tool. 529 plans for education savings. If you're saving for education, 529 plans are a highly effective way to invest with tax advantages. These state-sponsored plans are designed specifically for education expenses, from preschool to college and even certain apprenticeship programs. Tax-free growth. Like a Roth IRA, investments in a 529 plan grow tax-free. As long as the withdrawals are used for qualified education expenses, you won't owe any federal tax on the gains. State tax benefits. Many states offer additional perks, such as tax deductions or credits for contributions. This makes 529 plans even more attractive if your state provides these incentives. 529 plans are also incredibly flexible. You can transfer funds between beneficiaries without penalties, making it easier to use leftover money for siblings, grandchildren, or other family members. Pro tip: if your child doesn't end up needing all the funds for education, you can repurpose the account. For example, recent changes in the law allow unused 529 funds to be rolled into a beneficiary's Roth IRA under certain conditions, providing even more tax-free growth potential down the road. By taking advantage of these tax-advantaged accounts, you can align your investment goals with powerful tax-saving strategies. Each account has unique benefits, but when used strategically, they'll reduce your tax burden and keep more money working for you. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.